Hi, today we are going to talk about the possibility of a UK property market crash, and I'll give you some reasons why we may be in for a UK property market crash, and I'll also give you some reasons why we may not be in for a UK property market crash. Whether you're in the market to buy a property or already own a property, you may be wondering, are house prices going to crash in the UK due to the current economic climate? House prices have been growing at rates far higher than income growth, and while I do not have a crystal ball, I'll try to give you a few points so you can make your own decision. Anyway, if it's your first time watching my channel, then my name's Ollie, and on this channel we discuss all things related to personal finance and investing, so please don't forget to subscribe, and if you get any value from this video, then I'd really appreciate an early thumbs up, as it helps the channel massively to reach more people. Also, before we get stuck in, I must be clear, I am not a financial advisor, and nothing in this video is intended to be financial advice, and if you want financial advice, you should seek a licensed professional. At the end of the day, I am just a guy on YouTube, so you should always do your own research, because this video is just for entertainment purposes only, and past performance is not indicative of any future results. So now that's out of the way, let's get stuck into the video. So there are many factors that affect the housing market, but there are a few key factors affecting whether we may be in for a UK property market crash. Firstly, inflation is a key factor. Currently, inflation in the UK is at 10.1%, which is its highest rate it's been in 40 years, and the Bank of England expects this to peak at 13.3% in October. But there's reports from Citibank warning this may reach 18% in early 2023, and Goldman Sachs even warned this could reach 22% early next year if spiraling gas prices fail to come down. And because we are paying more for items, people have less disposable income. And when it comes to mortgages, banks will lend money based on disposable income. So if people's disposable income falls, then we can borrow less and therefore can't afford as much in the housing market. The second reason why we may be in for a UK property market crash is rising interest rates. So to combat inflation, banks raise interest rates, and the idea behind this is that people are more likely to save money than spend money when interest rates are higher, and in turn creating less demand for goods and so bringing prices down. So the Bank of England has raised interest rates to 1.75%, and this is likely to rise again in the future, with traders betting the Bank of England will raise its benchmark by 250 basis points to 4.25% by May of 2023. But raising interest rates doesn't just affect savings, as it also affects loans and mortgages. Mortgage interest rates are set just above the Bank of England rate, which means your mortgage will cost more and people will be able to borrow less. Low interest rates over the last 10 years or so have increased demand for housing. 0% interest rates made it cheap to buy a mortgage, and this brought in a much better return than keeping your money in a bank. So it increased the demand from buy-to-let investors, as they made money from renting the property as well as the increase in equity. But higher interest rates make mortgages much less attractive to buy-to-let investors. It's worth noting that raising interest rates also affects businesses, as it affects their ability to borrow and even hire workers, which we will come on to shortly. Another reason why we may be in for a UK property market crash is because of fear and the looming recession. It's hard to watch the news at the moment without hearing about the rising cost of living and rising energy prices. Bad news spreads faster than good news, and psychologically we are drawn to bad news. So the news channels are always going to be talking about it. But as the recession kicks in and with energy prices rising, people will likely hold back on taking on new debt in times of fear and uncertainty. No one wants to end up in negative equity, so it's understandable that people may just want to hold on to see what happens. Unfortunately, if you think now is bad, it is actually going to get a lot worse. If you've not seen my video on how high energy prices will go, then I recommend you check that out up here, and I'll put the link to that in the description below. But these higher energy prices will affect mortgage companies' affordability calculations, and whereas people are currently paying on average about £165 a month, this may be as high as £355 from next January, and potentially even higher again come April 2023. There are many people already struggling to pay bills who are in full-time employment, and this is unfortunately only set to get worse. If you look at this chart here, the big falls in the UK housing market were all during recessions, and the Bank of England predicts we will be in a recession by the end of 2022. If you haven't seen my video on whether we are heading for a recession, I recommend you check that out up here, and I'll also put the link to that in the description below. But basically, in a recession, unemployment rises and there is less job stability. And so less people can afford to buy houses or even want to take on a load of debt in a time of uncertainty. When people have less disposable income, it means they will buy less goods, and when people buy less goods, companies make less money, and when companies make less money, they may even look to reduce their workforce, which we are already starting to see. Many businesses are also struggling to run with the surge in energy prices, and many are asking for a small business energy price cap, because without it they may not survive this winter, which will lead to more layoffs. In the past, the government has helped bolster property prices when the growth has slowed, but due to the cost of living crisis, it's likely that this tax revenue will be needed in other areas. Unfortunately, some households pressed by rising prices and falling real wages may be forced to sell, and when forced to do this, some people will need to act quickly, which means selling at a cheaper rate than the market, or selling at a cheaper rate that they could have if they were given more time. And the more people in this situation can mean an increase in supply of properties to the market, again pushing prices down further. But not all factors may lead to a UK property market crash. Currently, there is still a low supply of houses. While supply constraints are improving, there is still a massive imbalance. According to Rightmove, the available stock is down 39% on 2019. They did say we have had our first fall in prices this year, but they have stated that property prices often tend to fall in August as people go on holiday. So it will be worth keeping an eye on this figure over the coming months. Another reason we may not be in for a UK property market crash is that there is low rental availability, which in turn makes higher rental values. And when rental values are high, some people consider the alternative of buying to potentially save money in the long run. Another reason we may not be in for a UK property market crash is because of shortages in construction materials from the impact of Brexit, COVID-19, and the invasion of Ukraine. Another reason why we may not see a UK property market crash is that generally more people are working from home and so saving more money on commuting and also possibly wanting to live somewhere nicer. Plus, for now, we still actually have low unemployment. But this is likely to be affected as we head into a recession. So this one may not last. If house prices fall, it's not so bad if you're willing to stay in the property till the market recovers. But if you have the unfortunate timing of buying at the top of the market, then last time in 2008, it took 2 years for London to recover. But in some of the slowest parts of the UK, this took 14 years. So it's worth researching where you're considering buying your house, as you don't want to be caught out and have to sell while in negative equity. So there are a lot of negative factors at play, but everyone has their own financial circumstances. So whatever you're doing, I would urge you to do your own extensive research and act with caution if deciding whether to purchase a property in the next year. But like I said earlier, none of this is financial advice, so please do your own research. Anyway, let us know below whether you think house prices are going to crash, stagnate, or carry on going up. I'm sure there are also many other reasons as to why property prices may go down or up, so please let us know your thoughts in the comments below, as I'd love to know and I read all your comments. If I get a lot of feedback, I may even do a follow-up video to this later in the year. Also, if you enjoyed this video or got any value from it, then please smash the like button, as it really helps the channel massively. And if you got this far into the video, I want to thank you so much for watching. Also, if you want to learn more about personal finance or investing, I have loads of videos on my channel, so I recommend you subscribe and press the bell icon so you don't miss out on any future updates. It's been Ollie from Get Geek Finance. Thanks for watching, and I'll catch you in the next one.